Hi, everyone. Good afternoon, good morning, and good evening. Good to have every one of us in our session today. And I say a very big welcome to you. Yes, I trust you are doing well, and I trust you are keeping safe and right. Yeah, yeah, yeah. You're in a good shape over there, and the weather is also uh, nice to you. All right, let me put it that way. So, once again, welcome to Financial Modeling Bootcamp. Time out with Victor on financial modeling. And today we'll continue with our third session. And for some of us that we missed the previous session, we apologize. It was later we got the message that some of us didn't get the email invite which was sent to us. So we also had to upload that on our YouTube channel for us to be able to catch up. So thank you once again. And let's continue from where we stop. Let's hit the ground running. So here we have our client work brief, right, which we are extracting our information from. And to some of us that were able to place your hand on getting this done, I must say a very big well done to you. And thank you for making that great attempt. Right. We really appreciate that. And also always remember, you can be watching it and you understand it, but when you get to do it yourself, that's when you really know that you know and you understand it. So please, let's always make attempt to make sure we do this ourselves, right? So let's continue from where we stop. So in our previous session, using our client work brief, we've been able to extract few information from it up to these business operations, and we encourage us that we should try and get that done on our own. So today we just continue. So let's just preview what we did in the last session. We've been able to extract our general macroeconomic assumptions, right? Just general assumptions relating to time and some other things. Then we also have our macroeconomic, and we said we've considered two things, which is our cost incremental factor, which we affect our cost, our expenses, and also pricing incremental factor as well. Then we touch base on provision for tax rates, and we said in case we need some other few things, we can always come back and add it to our input. Then we have our financing assumptions. So we have our sources of funding, then our cost of funding as well. We've extracted it, and we have also listed what we'll be using the money for. Right, the investment that we want to get, what we'll be using that for. So we have that already. And then on the part of the operation, which is where we stopped last session. So let's just continue from there. Let me start to our client work brief, and I will start from this. So please list your product, services, and their respective prices. They're telling us that, you know what, we'll be selling bread. So I think it's more like a bread, wheat bread, and multigrain. I think just these two products. So let me come straight to my input. Let me zoom out for us. So the first one, things done faster. And when they say the lazy one, it's not as if it's the lazy like that. Just trying to say, you should just think about this the smartest way. So instead of typing it, I'm just copying it from my Word document and I'm putting it here. So that's what they are saying. All right. So USD.
Hi,
So this will
Emmanuel.
be
I'm fine. Good afternoon.
all right. So this will be our USD per unit. All right. USD per unit. And how much? Let's look at this. So 3.18. So let me put this in our input format. So 3.18. Then this other one, 1.95. So 1.95. Okay. So remember I've mentioned that whenever you are building your model, it's always good that you make provision. Think about flexibility. Now, they might decide that, you know what? Yes, our prices will remain constant. Our prices will remain constant. So which means here, we copy this for the 5 years. We are correct if you are doing this. Because by the time we are doing our calculation, we are still going to apply our pricing factor. on this. So which means by the time we are building in our calculations, even though yes, we are stating this will be 318 constant for the year, by the time we apply our pricing factor on this, definitely it will have impacts. One. Then the second thing is, it's always good that you make provision for a kind of management growth. So there are some businesses, they'll say, okay, you know what, we are going to start selling at a lower price. Then by the time our product is well known in the market, then we can now increase the price to meet up with our competitor or just something like that. So modeling is not an isolated thing, right? As a modeler, it's also good you have a little bit understanding of a business plan. So if management is saying this is our plan, this is how we want to enter the market, this is what we're going to do, then the financial must also be able to tell the same story, right? So here, let me put this and let me call this our price per product. I will call it product price, either ways, right? Okay, so product price. Then let's now make provision for growth. Let's make provision for that growth. So in case they decide that, you know what, so maybe we start at a lower price, then increase it. So I'm going to call this will be wheat bread, growth. Then this will be multi, so multi grain growth as well. So this will be more like a percent. This will be a percent, and then put it from year 2 to year 5. So I'll put this in percent. So which means I'm going to delete this input, right? And I'm going to put in our growth formula that we use whenever we want to forecast. So, and that's more like one of the most important formula that we use whenever we want to build any model. So the formula is, we are saying last year value multiplied by, open my bracket, to 1 plus our growth rate. So last year value multiplied by, open your bracket, 1 plus the growth rate, which is the same thing that we are going to use. So here, because when you are building your model, you just trying to think about the flexibility. By the time you're done with the model, or you also think you should be thinking, I just want to build this model and hand it over, and someone should be able to do the updates, and not that they will want to update the model and they will need to come to be calling you and all those things. So make sure you build that flexibility, different thing, right? So as I said, yes, we could have decided, you know what, this is constant. But they say, okay, maybe by the year 3, we might likely increase our price by 10%. Year 5, maybe by 5%. Immediately we start entering the market. So you should be able to build in those growth factor already. So here, I will now put my formula equal to my base year, which is the last year, multiply by, open my bracket, 1 plus the growth rate. So I'll just link it to that growth, close the brackets and press enter. I will drag it for the period. It's giving us the same value because our growth here is 0. But let's assume, maybe in year 5, they might decide to increase the price by 5%, right? Assuming you will have been able to, your product will definitely be of great interest to people in the market, right? And definitely they will definitely want to do what, want to buy more. Yes. Okay. So Ateru, you're looking good. We can see your face from here. You're looking good. I don't know, maybe you want to switch off your video. Okay, I'm not sure he's aware that his video is on. All right. So let me just repeat the formula again. The last year multiplied by, open my bracket, 1 plus, then the growth factor here. Then I can copy that like this. Okay, and for us to see the flexibility of it, in case they decide, oh, you know what, this product 1 might increase the price in year 3, and they just need to come in here and just type their 5%, and you see it moves from 3.1 to 3.34. Right? Maybe in year 5, they might even want to reduce the cost. Maybe they just need to put minus 5% here, and you just see what happened. So this is just like a kind of management growth, right? And this is different from what the effect of the macroeconomic data will still be on the price. So always think about that flexibility. So I'll just keep this constant. I'm saying, you know what? Let's just keep everything constant at 0%. And in case they want to increase it, they can always do that increment. And maybe by the time we are presenting the model, decide, oh, you know what? Oh, the price can be constant. Maybe in year 2, year 3, we just decide to increase it, or maybe we'll be increasing it interval of 2 years. It's easy for them to just come here. Maybe in year 3, the price will increase by 10%, right? So it's easy to just put that percent and you see the value will just automatically update itself. Now, this next question you might want to ask is then, because this is formula, why are we putting it in an input format, right? So I think I will just try and make a little bit of change to that. Okay. So there are some things that we call inputs hard coded, and then there are still some inputs, right, that can be changed as well. Yes, we use formula to get it, but what if they decide that, you know what, maybe this percent will not even give us what we want? They can still decide to override the formula and come here and say, oh, maybe in year 5, where they don't want to do the stress of getting the percent. Oh, maybe later it's going to increase to 4.5. You can just put there 4.5. Right, but as long as it's inside your input cell, you just give them that of freedom, the flexibility to be able to change that as well. So please have any question, please let's make sure we type in the chat box so that we are rubbing mind, we are sharing knowledge. Okay, so this is for the price. Then we now need for the quantity. So as I said, as a modeler, those professionalism in the way you put your model together is very, very important, especially the input. Someone should be able to pick it and flow and understand what you've done. So this one will be our quantity. So we can just link this to the name of our product. And let's go straight to our client work brief. So please list the cost attached to each of the item listed above. So let's even work smart. So since we have this, what I'm going to do is I'll come to my direct costs. So consistency is also very good whenever you are building anything. It just allows you to be able to reuse it anytime. So I'll copy everything I put here for my price, right? And I'll come to my direct cost and just paste that. And I'll paste it here. So I'm just trying to work smart. Then I'll call this our cost. So cost, this is cost per unit, right? And I can come here and let me update that. So 1.36, 1.36. And then the second one will be 0.68, 0.68. And you can see the formula is still picking the same thing, right? So let me turn this back to 0 and 0. So also for the cost, by the time we are doing our calculation, we are still going to apply the effect of inflation on it. But what we are saying is here are just for strategic adjustments or updates. So maybe if management is, so we're going to increase it by 5%, we're going to increase it by 10%. It's easy for them to come here, right? Why we are still factoring the effect of macroeconomic data on each of these. Okay, so you can see we've listed our cost, simple as that. So for our quantity, so the target is to sell 5,500 units. So the first one, so I'll just call this unit, put this as my input for the year 1. So 5,500, so 5,500. Then the second one is 500. Now remember, this is units per month. This is unit per month, right? Okay, yes, monthly. So please, it's very, very good, right? Units they will be selling monthly. So which means in year 1, we are saying on average, this is more like what they'll be selling month on month. So it's as good as if we are saying, oh, this 5,500 will be constant over for the first month. And there are some models that you build in such a way that you need to lay out all the inputs month on month to be able to capture the maybe decide that, okay, you know what, we are not using the average unit that will sell in a month. Just want to know that, oh, month 1 we are selling this unit, month 2, month 3, month 4, they can fill in that unit respectively. So if that's the case, you might need to just lay everything. Maybe year one, this is the expected units they will sell. Month year two, this is all what they will be selling for the month. So it's always good you keep that in mind. Then for the growth, so you also need to also factor in the growth for each of these. So we are saying on average, this is the unit that they will be selling. So let me work smart, right? I can just copy this same formula. So that's why structuring of model is very important whenever you are building your model. Yes, yes, facts. The standard even says that, and it will be easy for you to be able to reuse and work smart. Now, for the growth, which is very, very important, the truth is, yes, we can leave pricing because you're saying pricing, you are still going to factor in the effect of a macroeconomic assumption on it. But for growth, which is what will be driving the revenue of the business, and we need to be able to state what will be the growth. Now, when it comes to quantity growth, it's a whole lot of work, and you really need to go into research. uh you can be lucky where the clients will tell you that, oh, you know what, okay, let's say we'll be selling 5,500 units in average monthly for year one. Then maybe in year two, based on our growth strategy, we move to 10, we expect to increase it by 10%. We expect to sell more in year three, right? Then we expect to just keep it as 5% for other years. Now, if your clients can give you this, perfect. You don't need to worry yourself. But most times, clients don't usually give you this growth. Just like what you're feeling here. Like, hey, the target is to sell 5,500 units of wheat monthly basis, and they will stop them. Now, you can still send question, oh, what will be your expected growth in the quantity and the whole thing? They might not know. And that's where you, as a modeler, that's where you need to come into play. As I said, you're not just a financial modeler, you're also a financial advisor. And you're also a research analyst. And also remember, everything, every value you put in your model, you must be able to defend it. So you cannot just pick anything from thin here and say that, oh, you increase by 10%, by 15%, by 5%, by 5%. The next question is, how did you come about this percent? Can you tell us where you got all this data from? So it will be an embarrassment where the investor asks you that and you just said, oh, it's just kind of a judgmental thing from nowhere. Then becomes a problem, right? So you really need to do the research. So you can decide to look at what's the industry growth, right? Each industry usually have what we call CAGR, so a compound annual growth rate, which always cover a 5 years period. For example, this is more like a kind of wheat bread. Which industry can we categorize this into? Anyone want to give us a clue? Which industry do you think this our business fall into? What do you think? What do you think?
Can we say FMC?
FMCG.
Okay, so someone said FMCG. Okay. So any other suggestion? I think the bread guys have their own food and beverages. Okay. Is it more of that? Confectional.
Confessionaries.
Confectionaries. Okay. Let me pick these confectionaries, right? But I'll leave that to you, as I said. And one good thing about it is it's not a one-way thing, right? And that's one thing I love about finance. It can face you like this, it can face you the other way around, and it depends on how you can defend, how you can defend it, right? So here, and that's why you cannot see two-person cannot build a model and you will have this exact same thing. I can have a different view. You can have a different view. You can understand the industry better than I do. I can understand the industry better than you do. And I can be able to give you. So it's all about story, right? You should be able to tell the story with different scenario. So let's say confectionery, right? Uh, so confectionery and so okay. Let's put it this way. Let's put it this way. So CAGR, which is what we call compound annual growth rate, usually cover a 5 years period for any industry. CAGR of a confectionery industry in US. So let's see. they're going to get anything around that. Okay, so revenue in the confectionery markets amount to 1.0. The market is expected to grow annually by 2.6.8. So they will also give you that period 2023 up to 2028. Right. And one other thing that I also love using, so by time, so you can just check different uh industry. So Statista, different sources, right? Statista is saying, okay, chocolates, chocolate, bread. Well, as I said, I will leave that to you. It's not a one-way thing. So the Statista is saying 2.6. Globe Newsfare is saying 3.8, right? 3.8, more like 3.9. Fortune Business Insight is saying 3.8. Another one. And not intelligent is say 4.76. So this is where it gets really interesting. Right. So macro, that's Madon intelligence. Then you have Grandview also saying 4.3. So that becomes that's where it now gets so interesting. So precedence research is say 2.4. Which one do we now decide to use? So while having this, there's another one I really love using, and I think I depend more on that source than other things. So there's what we call a Damodaron. So let me go to Damodaron websites. Okay, Damodaron websites. What happened? So we just go to Damodaron websites. So it has a website where you can actually get industry data as well. You can get all this industry data. All right. So where is it? Where is it? Where is it? Okay, so I'll just go, let me go to the data. So go to the data website and we can see. So I can select current data, and here you can get to see different industry growth, industry kind of growth. So let me see, scroll down. So market capitalization by industry, employee statistics. So this is more like house of data where you can get, let me check that. I know there's where we have the market where you can actually so estimate growth rates. Okay, so yeah, so let's check this return fundamental growth in, okay, that's earning per share, historical growth rates, earnings by industry. So fundamental growth rates by industry. So you can actually explore this on your own, right? This is more like we use this data from the Damodaran as in the professional industry space a lot, right? So it will be a good one. So let's check this. So this data summarize historical growth in earnings and revenue over the last 5 years by industry. So okay, now let's check our industry. So you can also download this in your own Excel file. But let's check our industry. I hope you'll see confectionaries here. That should be under C. And if we are not going to have that, that means we need to put it under another, look at it from another industry. So confectionaries, I'm not sure we have that. So someone's also said food and beverages. Let's see, food and beverages. But are they really producing? I think they are more like a retail business. So we also need to keep that in mind. So food processing, food wholesalers. What do you think about food wholesalers? Food, they are not food processing. They are not producing. They are more like a kind of retail business. So they buy from the manufacturer and they sell. Which one do you think we should go with here? Food processing, food wholesalers, food processing, food wholesaler. Which other one? Let's see. Household products, consumer products. Okay, is there consumer products? Let's look at this. Do we have consumer products? No, there's no consumer products in the industry classification. Right. Okay, so someone is saying we can also compute the what? We can compute the average of it. So I'll just leave it to you. As I said, it's really not a one-way thing. And the whole objective is for you to be able to defend your what? Your assumption. Not only to be able to defend it, but also your source of data must be a well-reliable one. Right. So for me, I think I would decide to go with this food wholesalers, even though the
So
sample.
going
Okay, so please let's remember to mute us, Mike. Right. So please, does this cover all countries? As I said, so you will see the list of number of firms that have actually been sampled before they will get the data. So you can see number of firms they've sampled, and this is across different industries, not as if it's just in one country or also. All right. So it's always good, but most times you just try to check different industry to be sure. Do your research across. As I said, you are a research analyst, and by the time you are saying, okay, we believe you are using this particular percent, you can always just tell, oh, we've done research around this, we've done that. Okay, so someone said I should share the link. Right. So irrespective of anyone, I will leave that to you. You can always decide that, you know what, this is what I'm going to use. So for this, our own, and let me see, which one can we use? I think let's go with this Globe News Wire, which is 3.9. Right. So I'll come here and just say 3.9. So you can keep that. So 3.9, you put your data source. Always remember that. Always remember to put your data source. Right. Now, that is one. So we are saying yearly, on average, in year one, this is the unit they will be selling monthly base. The year two, this is remember, this is average. This is average. And this growth percent that we've included here are what? Are annual. That is one. Now, the second approach that you use is this. Now, looking at what they are telling us, this average they will need to sell monthly. You can decide to build it annually, but my own kind of approach, I usually like building a model monthly, so that it also allows them to be able to see what the true picture looks like monthly basis. Now, this is one approach. Now, this is second approach. So we have the second approach, which I think I love using a lot. So what I'm saying is, so I'll say this is more like the base unit they will start with, but I can just put this in the input as input like this. Then I will now make provision for growth, which will now be the driver, which will be what will be driving this. So I'll put this percent. I'll put this percent. So if you are building yearly, this first approach is fine. But because we are going to build our own monthly, which is what we capture the true picture of what the business will be doing. So this will be percent. So this will be the growth monthly basis. Right? So which means the base, we are saying this is likely what they will start with on average for the first month. And then we expect them to be able to increase their revenue, the quantity they will be selling on average yearly. So this will start from year one. Right? Now, the second thing you also need to keep in mind is this. No business grow on a straight line rate. I'm not sure I've seen any company like that you look at their revenue growth or something and you see that the growth is constant. Now, once you build your home model and it's kind of showing a constant growth, yes, for a typical corporate organization, most time we usually use that. We say, oh, we look at the average of what they've done in the past and we say this will grow at a constant rate. Fine. But for a typical startup, I'm not sure, there's no way your revenue can be growing on a straight line rate. And this is where when you are building a model, you also need to be able to align with the business growth strategy. The truth is, there's no business that grow on a straight line where you say, oh, your quantity on month on month, we just keep being like this. So that's where the strategic thinking now comes into play. That, oh, yes, that this is what the industry is saying on average, but we believe because this is a startup, we believe they will start slowly and over a period of time, they will keep increasing their growth. And so you should be able to tell the story. And now, story is one. Then where you are really not sure of the data, that is where scenario comes into play. I think we are going to cover scenario later, where you see how you build your scenario and sensitivity for data that you are really not sure of. right? And management have not been able to provide you that, oh, you know what, monthly, this will be our growth percent. We hope to grow by this, and you just put that into the model to flow. But once they cannot give you that, then those kind of data now form the base of what you need to use to create different scenario where you have your base case, best case, and worst case. We are going to do that later. So, but for this one, right, what I'm going to do is I'm saying, okay, since the industry is showing CAGR of 3.9. Remember, this is they've actually gotten this from a mature company. So also keep that in mind. And you can say a 5% increase in Coca-Cola revenue growth cannot be compared to 120 growth in the revenue of a small startup. So those are things that you also need to keep in mind. So this, what I'm going to do, I'll just use more like a judgmental kind of thing. So 2.5, but remember, you must be able to defend everything, tell the story. But this is for the purpose of our own training, right? That's why I'm giving you different options that you need to, that you can use. What applies to A might not apply to B, right? And it might even apply, a mixture of it can even apply to any. If you are not sure, okay, you know what? If you are not sure of how you want to go about it, just make sure you can just decide, you know, oh, if I've taken a look at the industry, the CAGR of the industry is saying 3.9 over the next 5 years forecast. And what I've done is, because this is a startup, so just for you to be able to tell a story, now it must be reasonable enough. Must be very, very reasonable enough. So my own, I can tell you, oh, I've taken a look at the industry, did some research, check this website. The industry expected compound growth rates is this, right? And what we've done, okay, compare. Those are more like a mature company. Now we expect our own startup business to be able to even to be able to sell more. So just you putting your story together. And what I've done is we've pegged our growth rates to be lesser than the CAGR of the industry and all those things. Different story, but I'll leave that to you. So 2.5, I'll keep it as 2, then 1.5. I'll just leave it like that. And maybe the last year 1%. So like I said, oh, I feel wheat bread might even we sell higher than that. So this 2, then maybe 1.8, 1.7, then maybe 1%. So I just keep this. So which means my model that I'm going to build will be month on month and not a yearly thing. But assuming I want to use a yearly one, then I'll be going with this, our first approach, right? So that we have one, I'll just remove this. We'll just be going with this with our second approach. We are building yearly, you can use that first approach. That's why I just decided to take us through that. Now, so we have our quantity and we have our what? We have our pricing. We have our quantity, then we have our direct costs. So let's look at our work brief. Let's look at the work brief. Do we have any other thing? Yes, okay. So what's your plan? What is your plan for staffing? Now, they've actually given us that this is more like their own other costs. In fact, we could also decide that, you know what, let's factor in some other costs that they might miss out from it. Let's say you're not just a modeler, other direct costs. And what we can say is this other cost can just be a percent of the revenue. So other direct costs, we put that as a percent of what? Of revenue. Just we making provision for some other expenses. We can copy this and put it here, and we can peg that maybe as 1% of revenue. And if it's not applied, all you need to do is to just change it to 0. Now, on the part of our operating expenses, you can see, always make sure you keep it simple. It's easy to follow through the structure. So someone is saying it, so this is the price, but this is what you've used as the expected growth year on year, right? And here they come to the quantity, or this is the unit they expect to sell monthly, and this is the expected growth. So which means everything in year 1 will increase by this stated percent, everything in year 2 by this stated percent as well. So for the direct cost, we're good with that. On our operating expenses, let's look at our work brief. The first thing was, what's your plan for staffing? So human resource. So I just called it personnel head count. Personnel head count. I think they used to put head count together, right? personnel head count. Sometimes you might be lucky, the client will give you the expected number, right? And at times they might not be able to give you that. And it's a whole lot of work, trust me. So so luckily they've given us this. So let's just put that into our model. So I splitted my screen into two. To do that, your window, then your right arrow or your left arrow, anywhere you want to put it. And you can select the other screen that you want to show the other app. So here it's telling us that manager, then sales staff or sales personnel, then factory staff, maybe guys that will packing and be putting the product together. Right, then accountant, then they have admin staff, then they have security. So most times you can always go to make provision for other staff. So just think about any update they would like to do. So let me just put this as a number. Right, so let me extract. This. So how many? For owner, 1. For salesperson, 3. Factory personnel, 3. Accountant, 1. Admin, 2. Security, 2. Maybe other staff, we can even leave that as 0 for now. So what this, you make provision in case they want to increase it any of the year. It's easy for them to come back here and do that. Then what about their pay? So this is the head count, then personnel, monthly pay. So now this is where the work now come in. Now they've not been able to give us what this pay will be. I think I intentionally left this blank. So they've managed to even give you the job role. Now, how do we now get so USD per month? The next thing is how do we now get the staff salary per head? How do you get the staff salary per head? This way you need to really work. And this way you need to go to your research and the whole thing. This way you need to go. Okay, so someone said they missed this. Okay, don't worry. You will also get the recording. Yes, we are moving a little bit fast today. I can get the recording to look through. So now, how do you get the cost? They've not been able to give you, right? And these are more like typical things that you face when you're actually doing a real client job. But them, they even manage to try to give you this, but they've not given you the salary pay. Now, at times you might want to send a message to the client. What do you think will be your proposed salary pay and the thing? Client might even tell you, and that's one of the reasons we are building this model, so that we can know that, oh, maybe we don't need to employ as much as we need to do. Maybe we need to outsource some and the thing, and they tell you, just please come up with something for us. That's where you wear your cap of being a research analyst. But please always remember that to tell your client that, okay, you know what, I'll do your research and I'll come up with some things. And that's one of the reasons why you also build a model. We think, oh, this salary pay is going to impact the profitability of the business. That means maybe you might not need to employ as much as this, or maybe you might need to cut your pay, and just this different kind of option. But you need to go do your own research and be sure of that. But for this one, I'll just put in some fictitious assumption. As I said, do your research, be able to get this. But most times, you should always try as much as possible to convince the owner of the business, to be your client, to be able to give you those data. And where they cannot give you the data, and then always make sure you tell them that, you know what, I'll just give a suggestion and we can both agree, especially if it's not in your country. But assuming this business is in my own country, at least I can know at average wise. I know someone in this job role, this might be their pay. Right. So this one, let's say a manager. So maybe it's $5,000. So I said these are just fictitious assumptions, right? So salesperson, staff, say the same thing. Accountants, maybe 3. So admin, security, compare that as 1,000. Then other staff, maybe 1,000 as well. Right. So I'll also make provision for any increment in salary pay. I just put this one, increment. So increment in salary. So this will be in percent. Let me copy this at percent format here. Put it here. Right. So 0, in case maybe they will be increasing their pay to 2 years or something like that. So you just trying to build that flexibility. So let me come here. Let me copy this format and I'll put it here. Copy and paste it here. So I can delete and I can put my equal to my last year multiplied by open my bracket 1 plus. This is our growth and I'm going to keep the row constant. So I can just put the formula once, copy it to the right, then I can copy it down. But everything is still making use of this growth. So in case they decide, maybe in year 3 we increase the pay by 5%, look at this, just affects everything, right? But let's put this as 0%. So that's for the salary pay, and it's be easy for them to do any updates. If you say, oh, maybe you might need more uh, staff salary, our warehouse manage staff, right? Or I need to hire more accountant as we increase. If they want to expand their operation, it's just easy for them to update those number respectively, right? So we are not yet done. Then we are left with our operating expenses. So this will be our operating expenses. Operating expenses. So please know that we'll share the recording with us, all right? And we expect you to be able to do this yourself. So for our operational expenses, let me just split my screen into 2. So window, left arrow, then select the other one that I want on my other page. So they said we need rent, utility, so maintenance, then internet. So internet, let me call this internet and some subscription that they might have. Then marketing, insurance, then they have logistic, logistics, then some other miscellaneous expenses. Miscellaneous expenses. So these are cost per month, right? USD per month. Then let me put the value for the first period. So the rent, they said we should see the use of funds. They've listed that there. So let me pick those ones that we have already. So 300, maintenance 750, internet 500, marketing 1,000, insurance, they've listed that up, so I will check that. So logistic 1, 2, and miscellaneous 400. So let's check that. So what will be our rent? So if you look at the use of funds, so the use of fund under that, do you have anything like rent? Okay, so prepaid rent, which will be 15,000. That's annually, right? Which means we divide that. I'll just come here. So equal to 15,000 divided by 12. Enter. So 1250. I'll paste it. I'll type it out as a value, right? Don't add code in a formula. So insurance, how much is our insurance as well? So our insurance is 5,000 annually. So I'll come here, just type equal to my 5,000 divided by 12. That will be what? So I'll copy this and just paste it like this. 416. So let's say 416.7, or let's just say 0.8. Then we have this, right? So also remember, I just create uh incremental growth, incremental growth in our OPEX to be percent. So let me just copy what I have here, paste it here. Work smart. I'll just copy these our formats. I'll put it here and then equal to last year multiplied by open my brackets 1 plus this our growth, and I'll keep the row constant. Enter, drag it to the right, and I can copy it down. Then we have this. It's easy for them to do any updates for any of the period while the formula is still applied. So remember, yes, this look constant, but by the time we are doing the calculation, what we've done is we are just making this being flexible for them to be able to update in case to decide, oh, maybe you know what, this period we might increase it, but that does not affect the effect of the macro formula that we're still going to apply in our calculations. Okay, so that's for the now on the part of our operating working capital, right? Operating working capital is a concept on its own. Maybe we might just have a time where we take a look at this, or you can look through some of my video on my YouTube where I've actually discussed operating working capital in details. But if you're an accountant, I'm quite sure you already know this, as I said, as part of the skill needed being a sound accountant. So we're going to have our current assets, right? And then we are going to have our current liabilities as well. Those two line items. So we have under our operating working capital. And the first one, we're going to have our inventory, right? I'm sure our accountant will still remember this. So inventory, then our trade receivables, right? Then we're going to have our prepayments. Then under liability, we're going to have our trade, our payables. Then let's just say we're going to have our accrual and other liabilities. Simple as that. So this concept we're going to use concept of this. Just going to use our this, and to simplify it, we are just basically saying for inventory, any stock that we have in our store, we must be able to sell it within a given period. That's what inventory days is going to say, is telling us that, hey, any product that we have in our store, we should be able to sell it within how many days. And I think these are breads, these are edible products, which means it must not even stay long, right? So remember, this also includes some finished product. This also includes some raw material products that we use as well. But I think if this is a retail business, I'm not sure this is supposed to have a longer inventory days. But also remember, you also need also doing your accounts reporting as well. Right. So, but for this, let's just say on average, any product we have in our store, we should be able to sell it within, I think, 5 days is even too much for a typical, for this kind of edible product. But let's still put it as 10 days. Let's put it at 10 days. So that this also include you placing your order, then bringing it into your store, right? Then you now being able to take it out of your store. Right. Okay. So someone is even saying we should use 2 to 3 days. But let's still put it as 10 days. Let's say let's assume they pre-order so something like that. Then trade receivables, which means anybody you sell to, you must be able to collect your product as soon as possible. Right? So trade receivables, anybody you sell to, the number of days that you give them to be able to pay you. Now, if you're actually selling to the supermarket, I think all the supermarkets usually have this a cash management policy. They ask you, bring your product, we are going to sell it, but we are going to pay you in so number of days based on our company policy. So receivable days, let's even say maybe take them a week, or let's just say 15 days for you to get your money. You give them the product, they'll tell you immediately we sell. It's after we sold the product that we're going to give you the money. Right. Then for prepayments, there are some expenses that you prepaid. For example, your rent, definitely you prepay it. And when you are doing your account, so you prepared at the beginning of the year, but when you are doing your account, you now split it into more like a monthly basis. So let's just put it as 30 days. Then trade payables, which means by the time they give you, so the same policy that applies to when you sell to your customer and they'll tell you, We are going to pay you so number of days based on our own company cash management policy. The same thing also apply to you, because your output is an input to someone, and your own input to someone is an output to someone, which means your own income is an expense to another business, and your own expense is another income to another business. So always keep that in mind. So for our trade payables, which basically means we are saying, hey, inventory, days it takes us to sell our own product, and number of days it takes us to get our cash, which is almost like 25 days. So which means your trade payable for a good cash management must either be equal to your inventory plus receivable days or higher than that. So if these two guys is 25 days, we are saying, okay, you know what? By the time we collect our own product from the manufacturer or our raw material from our suppliers, we consider this, you know what? We are going to pay you. Maybe we put that as 20, let's even say 25 days, or let's say 30 days. Now, it depends if the supplier would agree to that, but most times you always consider your inventory days, your receivable days, the summation of the two to be able to match your trade payables. If it does not match, that means you need to go and get funds somewhere to be able to settle this guy. So for accrue, let's also put that. Let's even say this should be 20 days. So in case you don't know much about operating working capital, I will encourage us to take our time to look through that. Okay. All right, so which means what we've done is we've been able to extract all our assumptions. So now let me make my assumption worksheet. Let me make it look good. I can even create a border so that it's easy for them to see the section of the model, right? There's some people when they build the model, you see they have revenue assumption in one worksheet, operating cost assumption in another worksheet, asset assumption in another worksheet, funding assumption in another worksheet. Standard the same. You really don't need to do that, right? Keep everything in one. Make sure your everything related to assumption is in one worksheet, and you can always do what? Use what we call outline, which what we are going to do. So you can see this. So 01. It's easy for someone to see this. So I will work. Let me work smart. I'll just copy this. Let me copy the format using my format painter. I come to the second one, which is funding. Right, change the number. So this becomes 02. So copy the format. The third one, which is our operations. So I think we put 03. Did we put 0 in front of others? So we are consistent. So, okay, 02, 01. Yes, good. So, and this way. So you can see, simple as that. So which means this model has 3 grouping. So which means we have general and macroeconomic assumption. The second one, our financing and our use of funds. Then the third one is what? Our operations. Keep it simple. Now let's now create our group outline, what we call group outline. And to do that, let me zoom down a little bit. So I'll come to where we have this, our headers for our heading 1, right? I will just highlight that column before before the next header. So you can see it. So I'll just highlight from this first header before I get to the second header. Once I've done this, I'll now go to my data. I'll go to my tab. So you have your home tab, insert, page layout tab, formula tab, data tab. So I'll go to my data tab. Then under my data tab, I will see this guy called outline. I think it's the last option that you have on your right corner of that tab. I'm facing my screen now, so showing at my right, and you see this group. You see on group, you see subtotal. So what we need is this group. I'll just click on this group, and I will click on group. So it's going to ask me, do I want to group rows or columns? I want to group rows, and I'll click OK. So immediately I do that, you see that one number will appear on your Excel as number 1 and number 2. Right. So if I click on this number 1, what happened? You see that everything that I have under my group 1 that I selected those row, we automatically collapse. If I do the same thing for the 2 below my header 2 and just highlight that row before my header 3, right? You can even use the shortcuts. I think that should be shift alt right arrow, your shift and your alt, then your right arrow. We also do the same work, and you click on OK. Now click on this my one. You see that everything I have on that too also group that as well. So the same thing for 3. I'll just highlight from 3, that 3 to the end. Right. So most times when you build your model, it's always good you also put, so let me do that. So I'll come to the end of this and just put my end. So I'll come here and just can shade that in maybe a different color so that's easy for them to know. So I'll call this end of, so maybe I call this end of worksheet. So put this in white. So it's easy for them to see that, oh, this is where everything ends. So I'll just highlight from that third header. So before this, now press my shift alt right arrow, enter. So it create that outline. So it's easy for someone to see that, yes, this model, this is everything that you have in the model. I've built a model like this, I sent to clients, and clients are like, Victor, there's nothing in the model. So this is group 1, right? So now let's assume, for example, under this general, we also have another subgroup. What I can do is you can still repeat the same thing, come to my second header, and that's one of the reasons why I had to collapse my first 3 columns so that it's easy to give us this kind of view, right? So I'll highlight from here to the next one, enter. So let me work fast, at least since we understand what we need to do now. So here, enter. So now look at this, automatically it will create step 3. So if I click on 2, look at this. So under 1, it's easy to see this is the header that we have. This is the header, and you can see the cross sign if you want to open for each of these sections. So let me do for the second one. So to open everything, I'll just click on 3, which means it's going to open everything up. So let me do for others, and you'll see how this will look like. So let me just do that fast. So in case they want to do any update, it's easy. So if I click on my 2 now, then you're going to see how this will look like. So this just read more like a book. So like chapter 1, under chapter 1, this is what you have. So chapter 1, chapter 2, chapter 2. So it's easy for them to see. Right. So if they want to see only the financing assumption, they can just click on the one. It collapses everything. Oh, under financing assumption, they click on this cross sign. Just want to see the financing assumption, and every other part will be collapsed. Right? So you can see how easy this is. Yes. So my shift alt, then your right arrow, but make sure you highlight where you want to group first. Okay. So to open this, I'll click on this 3, and we can have everything open here. Simple as that. Okay. So now that we've extracted all our assumptions, the next thing we need to do is to get started with our what? With our calculations. Is to get started with our what is our calculation? Now, we are going to build this out month on month. And in the previous session, I remember I mentioned to us that the first thing that we need to do is to do what? Build your model template. Now, we are not going to do that in our session because I already have a video on it on our YouTube. So I think after the meeting, I will share the link to our recorded session, and also I will share the link to that video so that you can also take a look at how to build a professional model template. Okay. So the next thing is for us to create our calculation worksheet. So I'm going to call this calculation worksheet. Right? Add a worksheet. Then here, I'll just collapse these 3. I'll collapse these 3 columns. I can even remove my grid line. So to remove your grid line, you can go to your view tab, and you will see this grid line on ticket so that it just looks like a book. Everything is white. Okay. So first thing, we need the name of our company. So I can copy that from here. But what I will do is let me copy this header so consistency is key. To this our sheet 1, I'll copy everything from row 1 up to this our row 5. Copy it. I'll come in here and I'll paste everything like that. So I'll paste it like this. So then I will rename it. This will be our calculations, or call it workings. So calculations or workings, either ways. Now, our calculation will be, so which means our model, because of the way the client has filled the data, right? So most times it's also your own call. But my own best approach, which I really love a lot, is building out your calculation monthly. So in case they want to see the monthly output, it's easy for them to see. So you build your monthly income statement, monthly cash flow, monthly balance sheet, and you can now consolidate it into, if they want to see a quarterly report, they want to see semi-annual reports, annual reports, it's easy for them to, all you just need to do is consolidate. Right, so it's always good. I really love that approach. Not that you build a model yearly, they send it to clients. Clients will tell you, no, we want to see a monthly thing, because this is a model, is to actually drive decision making, and that's the way it applies in a typical corporate organization. So they want to see what is their actual, what is their budget, and what is their forecast. So it's to enable decision making. So, and you as a modeler as such, you must be able to do that same thing in your model, right? Okay. So let's build that. Let's build that. So we need a 60-month period. So for this, I'm going to remove that here, because this will be more like a monthly calculation. So I'll need to update this. So instead of this month, this will just be 1. So 1 will always be 1. You don't need to, yeah, though it's a sin for you to add code in your formula, but 1 will always be 1 anytime, and 0 will always be 0. So we need this for 60 months. So let me do this. So this period plus 1. I can drag this. So this, I need 60. So I need 60. So let me see. Okay, 56. So we need 60, because it's 5 years, right? So which means 12 times 5, that will give us 60. And the next thing I'm going to do is, I will now do what? I'm going to close my Excel, so that it will be easy for us. So by the time we remember left to right consistency, just build for year 1, and you do what? And you copy everything for the other period. Okay. So what I'm going to do, since I know that this is where my model will end, I'll come to this, my column BQ. I will click on it to highlight the column. And on my Excel, on my keyboard, I'll press my Control Shift, my right arrow. So it will take me to the end of my Excel. Once I've done this, then I will right click and now select the option of hide, which means I've hidden everything, and now my column stop at this month 60. And what this will do is it will help me to be able to put my formula in month 1 and just drag everything for the period. Right? Okay. So Simon, you might want to check. You are trying to on your video. You might want to switch that off from your head. All right. So now that I've done this, all I need to do is to come here. Okay. Yes. Daniel. Oh, okay. Okay. Right. Understand. So I come here. Right. I can highlight. So since I've put my formula, the date for month 1, base period plus 1, then e date to give us the end of the month. So I can put my year formula to just select the year from the date. Enter, Control Shift. So just to make it a general format, and I can highlight everything like this. Hold my Control Shift, right arrow. So I select that to the end of my Excel, and I can press my Control R. So that will do what? That will help you to drag everything from month 1 to month 60. And you don't have to be doing that one by one, or you just dragging. So this just help you to work what? To work faster. So do you have any question on this? You can see everything is month on month. So if you look at our input where we have it on yearly, starting from 1st of January to 31st December 28. And if you look at our calculation, 1st of January to what? To December 38. So we have everything laid out month on month. Let me call this period counter. Yes, Mesa, you have your hand up. Any question? Please go ahead.
Yeah, hello.
Yeah, we can hear you, Melissa.
Oh, sorry. Good afternoon.
Afternoon.
Okay. So, quick question. How do you unhide the rows after you've hidden them? The
Oh,
rows
very
that
good.
you don't
Very
need.
good one.
I mean,
Mm,
the
very
columns.
good question. Yeah, very good question. Thank you. Thank you. So you can, because you have all those questions, you can just type it in the chat box. I can see the chat box from here too. A very good one. So you're saying, what if we don't need, maybe the client comes later and say, okay, you know what, can you extend this model to 10 years, right? Or let's just make it a 3-year model or something like that. And you want to unhide this hidden part. All you just need to do is to come to this last column. So I'll come to my BP column, click on it as if I've highlighted the old column, right? And I will click on my mouse, left click my mouse, and I will assume that I'm dragging it again. So immediately you start doing that, it will automatically, Excel will show you a kind of the total number of row that you have and the total number of column. It will just kind of show it to you as if you are at the end of it, right? Click the first column, do as if you are dragging it to the end. It will just show you the total number of that column and the row that you have. And then in that worksheet, then right click. Once you right click, you see this option of unhide and you click on unhide. So you see that automatically it will unhide it. So as I said, let me do that again. Let me do that again. Okay, so automatically, let me do that again. So it ends here at BP, as I said. Come to the end of it, just click on the BP as if you are highlighting the O column, right? Your left mouse and do as if you are dragging everything, like you want to highlight all the columns to the end. So Excel will automatically show you the total number of row and the total number of column that you have in the worksheet. Once you see that, remove your hand, then right click and on the option select on hide and Excel will automatically open it out for you. So the same thing you can do for the row, you can do for the column. That's how you unhide it. So you can also use shortcut. If I click on this BQ, Control Shift to the end arrow, Control 0, it will hide it automatically. Okay, all right. Thank you for that. A good question. Good question. So now that we have this, right, I always like to go with the flow of the way I've done my input. Now, also to keep this in mind, there's no one way or two ways, or more like a let me put it more like if it's not as if it's a force that you should use this approach, right? Remember, while we're creating this our own assumption, we've just used the concept of what of our business cash flow to tell the story that hey, you want to do your business, you do the general macroeconomic uh, research, right? Identify things that can affect your business. After that, you tend to get the first cash into the business, which we expect to get through your funding, your financing. Identify the different costs attached to you getting that funding. You tell us how you plan to make use of the funds. Immediately after that, then you start your business operations. You tell us, oh, this is how you'll be generating your revenue and your quantity. You tell us those costs attached to it. You tell us the cost of operating the business, then the working capital of how the business will be managing its cash. Simple, right? You might decide, oh, maybe in your own, you want to start with revenue. That's fine. So it's not as if it's a rigid or is a by force approach. I just use this approach so that you understand the flow of the business and how that's actually flow into the modeling, so that anytime you want to build any model irrespective of the industry, all this just the concept remains the same, and those are the guide you on how to ask the appropriate question. What do I need? So from the output to input. So your own, you might decide, oh, you know what, I want to start with revenue assumptions. Fine, you are good. So it's not as if you now see someone that start their own model with revenue, you're not saying, oh, no, 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 that is no. Finance is very flexible. Your own is, oh, I believe the umbrella of the business is revenue. That's how some people approach it. That, oh, the driver of the business is revenues. Is the umbrella of the business, right? And that's where we must start from. So if you see someone that start their own from there, it's not as if they are wrong. It's not a one-way thing. You can decide to even start your own with your operational cost. You can decide to start with operating working capital. You can decide to start with funding. So you can decide to start with anything. The whole thing is, if someone is running through the model, is there a flow in it? There is good structure, right? So the same thing also affects the calculation. People believe, okay, you can start with operations, right? Start with anything. The ball is in your court. So let me change this. Description, unit, instead of input, this will be linked. Then we can have our total column here. So let me now freeze my panel. So I'll come here, but let me bring this my counter. Let me bring it up here. And I'll come here, just on my cell E7. I'll click on it, go to my view, and select my freeze panel. And just freeze the panel like this, so that when I scroll down, yeah, you can see them fixed. When I scroll to the right, you can see that what I have, anything I have in column A to D will also be constant, will be there. Right? So you can decide to start your own calculation with revenue, anything. The ball is in your court. You are the one that is drawing it. All right. Okay. So before we go, let's also come here. Let's come to our input and add something. So as I said, at times it's when you are building, you want to do a calculation, you need something. You can always go back to your assumption and add it. So here, let's call this our year. So this is year count. Year. Okay, let's just call it ordinary year. Right. So year. And here, all I just want to do is equal to year. I want this to extract the year for us. So extract the year from the date, and we have this. So we are going to need this in our calculation. So this is very important. So this represents year 1. This represents year 2, year 3, year 4, and year 5. Right? So you can even call this year counter. So year counter, and just say equal to base period, which is 0 plus 1. We have this. So this represents, copy it to the right, year 1, year 2, year 3, year 4, year 5. Simple as that. Okay. So now we come to the calculations. So because I would really like us to work with the flow of what we have here already. So let's start with our general macroeconomic calculations. Okay. So I'll come in here. So the first one, let me just copy this header. Then let me repeat work. So I'll copy this. I'll come here. Start from here. And let me even copy this. Copy it for everything. So the first one is general macroeconomic assumption. And under it, let me copy this one. We need to start with our general data, right? So first thing, we need our days in a period. So days in a period. So we just want to count the total number of days that we have in each of these periods. So equal to my current end date minus my previous end date. So building a monthly model is very, very important. Trust me, it's very, very good. In fact, I've worked on a few projects, right? Which is more for they use the model. The model is kind of a strategic model. And that model, all I had to do is, you notice that all our inputs here are kind of yearly. When I did that, I had to make everything monthly. I had to make it monthly so that it's easy for them to even be able to match their actual, and they just come to the model, right, and update it. So the model just kind of incorporates a kind of actual and the forecast. They say, oh, so June, our quantity sold we were able to increase it by a 5% from previous period. So they come to the model, they know that, oh, that means the 12% or the 15% we said we are going to sell next month might not be achievable, because previous month that we said we are going to grow by 10%, we are unable to achieve it. They change it back to 5%. Or maybe this month, let's just mirror the reality of it. And that's how it kind of, when you are building that model. So 31, remember, left to right consistency, build the model once, put the formula once in the first period of the model, and align it to the, so Control Shift to the end, Control R. Automatically do what? It's going to do the calculation for us. Right? Now, the second thing is we need This our 366 days, 365. So this one, I'll just call it days in a calendar year. Right. So since I have them here, all I just need to do is I can just look them up and bring it and bring them here. And to do that, I will need to use this my year tag 2024, and I also have another year tag here which is 2024. And to do that, I will now need my lookup function. That's why you as a modeler, you must be a sound Excel user. Trust me, you don't have any other option. So I'm going to use our lookup function, lookup. I know most of us don't usually use this lookup in Excel, and it's a very great tool. So lookup is only going to ask you for three things. Number one, lookup value, what you want to go and look, the value you want to go and look for. Now the next one is result vector, in where. Then what do you want in return? Simple. So they said, hey, I want you to go and look for this 2024 that I have here. Go to your input, come and look for it here, right? And give me whatsoever thing that I have here. So go and look for this value in this range and give me the results that I have in this range. So I come here, so let's try it. So equal to lookup value, look for the year that I have up here. But this is monthly, so 2024, 2024, as long as it is that year. So comma, should look for it where, lookup vector, I'll come in here, should look for it in the list of year that I have here, which I'm going to keep constant, my F4 ones. Then comma, it should give me results. What's the result? It should give me what I have in this range, which I'm also going to keep constant. Close my bracket and press enter. Now I'm going to do it again. Equal to lookup. So I believe we are working with Excel experts, right? At least intermediate. So lookup, open my bracket. The first thing is requesting for is lookup. So every Excel formula, you always see the syntax there. Lookup value. Oh, yes, this is what I want you to look, comma. The next thing, lookup vector, come to my input. Should go and look for that 2024 in the range of dates that I have here. Effort to keep it constant, comma, then the result vector, which is what I have this year counter, and I'm going to keep that constant and press enter. So if I drag this for the period, so you will see everything here. So we expect this to, so you expect to see one for the next 12 months. So you can see, so from one period counter 1 to 12, you can see that that is what year 1. Then everything from 13, so 13 to 24, 30 to 24 months, that will be what year 2. So you can see everything there under it is 2. So just like that, that is one good work, what it will do for you. Right. So which other thing do we need? Which other thing do we need? So any other thing we need, you can always come back and do the calculation there. So that's for the general. Then the next one will be our what? So let me just create two one. So macro. So I'll come here. So at least we can finish this macro today. So I don't want to overload us with much. Okay. So here, macroeconomic assumptions. And the first one we need is our what? Cost incremental. So cost. So this will be our cost incremental rate. So we need our rate first, which will be in percent. And you know what? Our lookup, we need to use our lookup function as well. Hi, Olariwaju. You can see your face. Okay, Olariwaju, you look good. I hope you are doing well. All right, so to do that, you see this same lookup function that we use, we can also make use of it as well. All right, and so most people usually believe building a monthly model very stressful. It is not. And I've seen many people the way they've built a monthly model, and I can imagine the number of hours they've spent on it. Right? So what's the essence of this in a calendar year? Don't worry, when we get there. So there are some model where you build, and as I said, it's just help you to go as granular as you can. When you need it, you can use it. And at times, it might be when you need it that you need to come back, and but you can just think about the whole model at once. That if I want to do a calculation, I might need, let's assume they are selling per day. So if you're building for a model where they've actually, you have to deal with, oh, this is the total thing that we need to do per day. So that means definitely you need a number of days in a month, in a period. You are building your own into monthly. So that means, oh, this unit per day, then multiply by the number of days that you have in a month, or number of operation days that you have in that particular month. Okay, right? So cost incremental equal to, I'll use that as my same lookup. Look for this year, right? Comma, come to my input. You should look for that 2024 in this our dates range. And for now, always remember that your lookup range must be the same, must maintain the same period range with your what? With the output range. So keep that, comma, what's my results vector? So it should return what we have here. What we have as our inflation, keep that constant, close the bracket and press enter. So when I say the same range, it means this 2024 is the range from what? I to M, and the same thing, your output must also be from what? To I to M. So they must maintain the same range. Then I can turn this to percent, right? So then I can copy this for the period. So you can see everything in year one, maintain this what? 2.3. And the same thing we have. Then everything in year two, 2.1. Okay, so someone say, please, can we calculate that again? Days in calendar year. Oh. Thank you for that. So we're supposed to pick row 9, right? So we're supposed to pick this row 9 and not the other one. Let me see. So days in the calendar years. So this should be a days count. Okay, let me see. This should be yearly counter. Then we're supposed to now have our days in a calendar, year. Yes, thank you for that. So you can also work smart, right? Once you put this formula, I can just copy this formula, copy it, paste it here, right? Because my lookup value, my lookup data and my lookup range is the same. All I just need to change is the output, my output, right? So now this is actually in row 9. So I'll just come back to my formula. My result vector that was 13 before, I'll just change it to 9. Just change this to 9. Change this 13. Just edit it to 9. And that will give us what we want, which is the days in the calendar period. Right? So in 2025, the calendar period will be 365 and not 366. Yes. Thank you for that. Thank you for pointing that out. So as a modeler, always remember, you need to learn how to give attention to detail. It's one very important skill that you must have. Okay, so now let's do our calculation. Let's do, so we have our inflation rate, which we now need to convert into inflation index. So I'm going to do it, I'll come to this, my input, and I will do it yearly. And you see the same thing that we also apply to monthly. So most people usually find it difficult in inflation rate. Remember, this is yearly, right? And what we are assuming is, oh, you know what? Impact of increment in your cost would be yearly. Because this inflation rate that we are using is actually a yearly rate. If you want to go granular, while you want to do your research, but always remember, and part of it is really you cannot be 100% accurate. And at times, the more basic you are, the better, so that you would not be caught explaining. And the more you create your model, you make it open to questions, the more you're actually spoiling your work, right? So yes, the inflation rate that we have is annually. And we are assuming that, yes, it's really not easy for you to get a monthly rate. And most times, if you even look at a typical monthly rate, what they will tell you, oh, last month the inflation rate was 2.3. Oh, this month it's either it has reduced or it has increased, it's now 2.4, or is now 6. But not that you see that, but if you want to go the extra mile, yes, you can now decide to pick what is the percent, what is the monthly percent increment in that inflation. But will you get that data for forecast? The answer is no. If you even look at annual projection of inflation rate for any country, they will always give us on what? On annual basis. So, and as such, we are saying, no, on annual basis, this impact of inflation will be applied to your cost on annual basis. Now, whereas you now want to go granular and say, no, this growth will be monthly, then you can now go the other way around, where you need to lay out your assumption month on month, and now you now make provision for this kind of thing that we did. So remember, in our cost, we are saying, oh yes, this is the expected, but this is in case they now assume any growth they want to apply to that cost, they can now include that percent. But it's always good you keep it very, very basic. So now we have inflation rates. So we usually convert it to what we call inflation index. And now for this inflation index, we have two methods. And I'll tell you the reason why we use that method. So for this one, what I'm saying is I'll come here. So I'll do this in a yearly thing. And maybe we just use our lookup to take that to our input. Or you can even do the calculation input base. It's still the same thing. So I'll come here. And what this concept is saying, now let's assume we are building this model today, right? And the business operation will start in June 24. This concept is saying we can only know what the cost will be today. So which means a cost today is the same thing as today. That is what that one is saying. If I go to market and I want to buy something today, I'm paying, if it is $10,000, I'm paying that $10,000 today. The cost is what it is today. But what will the cost will be in the next 1 year, I might not be able to say. So they are now saying, if I'm saying, oh, I will be selling, I have an expense to cost me $5,000 today. I'm only saying it based on today. What it will be tomorrow, I do not know. So it's a real-time nominal kind of thing. So this method is saying is only one. Today is today, which means anything that I'm saying and I'm forecasting, we should include that effect of the inflation, because I don't know how much it will take me in the actual sense. I'm only stating the base. So this base, which is that one, multiplied by, open my brackets, 1 plus this is our growth rate, enter, and I can copy that. In fact, let me format it to show as multiple so that it will look like this. So which means anything I want to buy, I'm stating the cost today because I only know it today. But by the time I start my operation in next year, the effect of inflation might have affected it. So this is saying it's going to increase by more like a 2 cents, just like what the percent are stated, and we are converting it to index. So basically what I'm saying is, if I'm saying I have an expense that will cost me $5,000, yeah, which means by the time I start the operations, that will now be what? This 5,000, which I'm keeping constant, so equal to this 5,000 multiplied by 1.02 index will give me 5,150, which means I'm having the effects of that inflation is coming on it. In the next thing, year 2, which I'm budgeting that I'll be spending $5,000 for the next 5 years. But in real sense, it's going to cost me more in year 2. I get to year 3, that same 5,000 will be what this. So it's more like a concept of that time value of money. Right, so you can see what that effect, and that's why the concept of modeling is very important. Because you are saying, yes, 5,000 in year 1. So it's as good I'm saying, you know what, can I give you 5,000 today? Or you wait for me in year 5, I should give you that same 5,000. Say, oh no, give me today, because I actually know it's what it will cost me today that it will cost me. In the next 5 years, it might cost me more. And that is the effect of that inflation forecast that we are seeing, so that the company can make provision for enough cash and to be able to make a necessary strategy in order to be able to curb that effect on their profitability. So 5,000 today, we are saying, yes, it will cost us 5,000. So without the effect of inflation, we are saying, yes, 5,000 here is the same thing. This $5,000 is the same thing over the 5 years. That would have been the basic thing. But before, we need to consider the effect of macro, right? That was saying this 5,000 will now multiply by index. This is what the actual cost would be. And the same thing applies to price, the same thing applies to cost. Okay, so that's for the method one, saying yes, we can only know what this is. How did you get the inflation index? That's the calculation that we are doing. Okay, I think you've missed out, so you might need to look through the recording again. Don't let me go through that. It's a whole lot of explanation to go through it again. Okay, so for the second method, now this second method is saying, remember the first method is saying where we are today, the cost, we can only state the cost based on the prevailing rate today. But in following period, it might cost us more. So which is what we just used. Say 1, which is the base for the index, and I'm saying equal to this 1 multiplied by, open my bracket, 1 plus this what? Inflation rate. That's how we got the index. So, and I formatted it to show X. So this one is just format. Then for the second method is assuming that, oh, the cost that we are using, we are assuming that we factor in the inflation, and we are sure that that is the actual amount that it will cost us. So for that formula, it's saying that will be equal to, open my bracket, 1 plus this my growth rate, open my bracket. So this one usually make use of period. So let me put period 3, 4, period 5. So this one is saying equal to 1 plus my what? My inflation rate for that period, then raised to, open my bracket, this period minus 1. Close the bracket. Don't worry, I'm going to type the formula out for us. And this is what we are going to have. So this other one is now assuming that, you know what? The cost that we have stated, we've already considered that inflation in it. And the actual cost is the actual cost. So you can see, so this one is as good as, this one is moving it. This one is saying, yes, base period is year 0. But this one is assuming that, no, the cost we've listed is set to be the actual cost for the first period. That we've considered that inflation factor in it. So you can see it's just moving it. What we have in year 0, this one is the base 0. This one is assuming to be year 1 as our base period. To year 2, and you can see that. So which means what will be the effects? If you're using method 1, it's basically going to tell us that it's going to cost us more, because by the time we get to year 5, but let me do that. So let's say this is our 5,000 here. It's our 5,000, and I'm saying equal to this 5,000 multiplied by this. Right? So by the time we get to year 5, we are spending almost like 5,500. But for this method 2, let's look at this method 2. Method 2 is saying this 5,000, we are assuming that, yes, that 5,000 is the same thing. So this 5,000 multiplied by this. So it's assuming that, yes, we are sure of the same cost. So which means by the time we get to year 5, this one is telling us that we'll be spending 5,433. The effect of this is, this will give us higher profits, right? Which means because we have a lower cost, give us, let's say revenue is constant, because here the second method will give us higher profit because we have lower cost. Why this second one, which kind of mirror the reality, will give us what? Will give us a lower profitability because we have so this method 2, we use it most times if you are dealing with our what? Our project finance, which is another concept on its own. So for this is the index. This is the index that we have. So the same thing for our pricing. I can also copy it here. The set is always good. Build your formula, make sure they are consistent such that you can always reuse it. So I'll call this our cost. So this will be our pricing index. Let me, instead of inflation, let me even call this our cost index. So here you can see this. So because of the same structure, that's why I don't need to type the formula again, and it just automatically do what? Pick the way I've done it. Now, remember why we were discussing this macroeconomic data, that we are assuming that, you know what, the cost increments in cost will be different, increments in pricing will be different. And you will agree with me, in reality of the business, the fact that inflation is increasing, you cannot increase your own product as such, because you need to consider your competitor. The fact that everything is increasing does not mean Coca-Cola will decide to just go ahead and increase their products, the product's pricing. Whereas other competitor, the like of Pepsi and some other soft drink, right, they maintain the same pricing. So those are kind of things that you also build into your own model. You ask, this is your product that you are selling, this industry you are you the price driver? If you are not the price driver, then it becomes a problem. In fact, there are some model we built. I will say that, you know what, because this industry, you have no power over pricing. What we do is we are going to keep your pricing constant. We will not apply pricing incremental rates, and we will not apply any growth rate on it. But we are going to apply inflation effects on your pricing. If your business cannot survive it, then that means you need to think about different strategies. So that's why it's called modeling. It's not about you just putting figures and you think you leave it. No, it's a story. It's all about strategy. Oh, let's say your cost will increase more than the way your pricing will increase. So the highest thing for you to now be able to net them off is on the more quantity you can now sell, or what are the other strategy that you need to, that you can take, right? So modelers, yes, we contribute to so many failures of startups, and this is where it all starts from. Because once you cannot mirror that reality, it becomes a problem. Because there's no way your price, you don't have control over the price of the industry. And you have seen a model, someone is saying, I will be selling at 5,000, at 500, let's say $50 in year one. Then you look at the model, by the time they get to year five, they're already selling at $250 in year five. Because they factor in those macro growths. And they don't have any control over the pricing. Now you now see revenue shooting out, profits shooting out. By the time they get to the reality, it becomes a problem, whereas the cost is increasing significantly, but they cannot increase price. Even if price will increase, it will be more like a slight growth, then it becomes a problem. So it's not just a model, it's not just a figures that you plug in Excel, it's about strategy, it's about story. So here we are saying, let's assume we are saying, oh, this business, they can actually transfer the increment in their price to the customer. But remember, we build this that cost inflation applied to price. If we change this to true, we see that the same index, the same cost index is the same thing that we have as our price index. But we put this as no, we put this as false. Let's look at this. Let's assume we have a cost that will be taking us 5,000. Right. So I'm just taking my time so that you understand this, because this is very important. And this is one of the reasons we build models. It's not about because of I just want to have a figures to present to investors. A real investor will ask you this kind of question. Now look at this. Let me look at the growth. Let's look at the growth. Even if this is one thing you understand today, I'm satisfied. Right. So this cost, let's look at the growth. So equal to this divided by this. Right. Let's look at the growth. So current year divided by previous year minus 1. Put that in percent. So let's look at the growth. Right? Now let's look at our price. Let's assume you now have a revenue of, let's say you have a revenue of let's even say a revenue of $6,500. So which means we are gaining a profit of what? So you have a profit of so equal to your revenue minus your cost. Right? So which means you have more like a revenue of 1.5. Now let's now look at this. So this revenue of 6.5 multiplied by what? Multiplied by this pricing increment. So this is what we have. And let's look at the growth. So current period minus previous, let me just copy this. So you have this. Now let's look at our profits. 1.5, and let's look at what the effect will be. So you can see, based on the effect that cost is increasing, look at profit. Look at this profit. So let me show that so that you can see this very well. So this blue represents cost. Let me change the font so that you can see it very well. So this is cost. Now this is, let me put the revenue in green. So this is revenue, which is in green. All right. And this is profit. Let me put this in red so that you can see it very well. So I love taking my time to explain this whenever I'm training financial model, because this is very, very crucial. Now look at this. You can see that profitability is decreasing. But let's look at the growth in that profitability. You can see that because of the inflation increasing significantly, look at how pricing is increasing. So pricing is increasing at a lower pace as compared to the way cost is increasing, which is the reality of every business. And you can see that because of that, profits keep decreasing every year. And that's where management comes into play. And that's one of the reasons they pay those management personnel, because they are the one that will now develop different strategies to be sure that how do we balance things off. If we cannot increase the price, what do we need to do? Oh, maybe we need to sell more quantity, or maybe we need to reduce that quantity in such a way that it still meet up for us to be able to use that quantity that has been reduced to produce more, to sell more. Why still keeping that price? Because this becomes a problem. That's why, oh, you know what? We need to sell more quantity such that revenue can still grow in order to be able to cover and meet up that, so that profit does not show as if it's decreasing, but it is increasing. So as a modeler, you really need to understand it. So let me remove this so that we go back to where we are coming from. Right, so I've taken my time to explain this. I'll also share the video with us so that by the time we are done with the model, immediately you look at a model. I've seen a model before that, multiple models. You just see that profitability is just dropping. And they'll be like, what has happened? What have you built into the model? And that's just the macro thing, and which is the reality. So now need to, oh, what do we need to do? Maybe they need to sell more to be able to, the more you sell, the more profit you can also generate to cover up the cost. So all those kind of strategy now comes into play, and that is what we build models. Because when it comes to, you want to value a business, this also impacts it. So macroeconomic data, they are very, very important. So I'll come to my calculations. Do we have any question, please, before we go ahead? If it's the only thing that we achieved today, I'm really cool with that. So you can see it's not only the artistical. You can come to the artistical, I'll just tell you, so do this, multiply by this, do this calculation, do that, and you think you have no. Okay, yes, please go ahead. So someone is saying, can we have the template also with the video? No. I'm not giving you the templates. And that's one of the reasons I ask you to, during the session, just listen, look through. If you are not clear, ask. So that by the time I want you to go back, you watch the video. That's why I'm sharing the video. It's also a cost to me, right? Before I do the conversion, save it on my computer. I'm using data to do the conversion. Then before I will now upload it on my YouTube channel, it's costing me data. But I will now send the email to you to now go through it. It's costing me data. So it's part of your own sacrifice. The fact that you're not paying does not mean it is free. It's now your own cost to take your time, sit down with it, right? Rewatch it again, apply it again. So are there businesses that can pass increase in cost 100% to buyers? Definitely. So let's leave that open. Let's leave that open. Let's even have that discussion, because this is one important aspect of modeling that's really mirror the reality of what goes on. Thank you for that question, Runke. Please, I would like us to open our mic. This is a very good question. Let's just talk about that one before we close the session. If it's the only thing we do, I'm cool. So are there businesses that can pass increase in cost 100% to buyers for our guys in the industry? Please, that's a very good question for us. What do you think? Are there businesses? So yes, please, I would like us to unmute our mic. So please give us example, give us a different scenario so that you can see that modeling is not just artistical. It is what we do. It is reality. So anyone, please, I would like us, let's make this open class. Anyone want to share with us? Are there
Okay.
businesses that can, okay, yes, please go ahead.
Thank you, Victor. Even though I'm the one that asked the question. So
Okay.
I feel like food, like people that sell necessities basically, and so our typical Nigeria setting and all of that, you even go to the market now, what you bought for 500, by the time you go back there the next day it's like 700. And the way they're even talking to you, like, if you're not buying, just go. When I went to the
That's
market,
good.
the price has increased. So I truly feel, I'm not sure, but I feel that these people, because they are selling necessities, they are able to like pass that cost 100% to consumers. So I don't know. That's just, I feel they are the set of people that can actually pass it to consumers.
Okay, thank you for that. I love that. Okay, yes, Wasu, your contribution as well.
I actually believe that majorly there are actually commodities that have no close substitute. Foods, there always be
Mhm.
substitute. When you say food, what kind of food? Because if you are not eating probably rice, you might be eating noodles and or some other things. So there's always be substitute. So the availability of substitutes will not make there will surely be variation in the quantity that will be demanded if you want to pass the whole price. But there are commodity like vaccine. If you have probably HIV, you have what was it called? The recent one, COVID. There's no substitute. So you know that okay, oh, is that I take the vaccine or I die. So even though the producer decides to increase the price by 100%, you have no choice
Like
than actually
pharmacy
survive.
industry.
Exactly, pharmaceutical drugs. Yeah, that's what I believe.
Mm-hmm. I love that. So Adeyemi even makes suggestion that transport sector, yes, there's increment in you getting the fuel of running your car. You definitely need to pass it, right? So those are I love that question. That's the reality, and that's why when you build a model, it's not just about putting figures together. It's about what will be. Have we been able to capture this? Is it something that we can capture? If it's not something we can capture, what are the provisions that we've made? Right? If I'm not the controller of the price, if I need to buy this, the fact that I'm selling this, I have a product I'm selling, right? I need to go to the market and get the raw material. The fact that yes, everyone has increased it, but my competitor they've not increased it because I'm not the controller of the price, right? How do you adjust those kind of? Okay, yes, Adeyemi. Even in a bank, right? When CBN increase MPR, customers are affected exactly. So then you now need to also ask the same rate the cost has increased. Is it the same rate that you can actually pass the cost? Yes, Adeyemi, please go ahead.
Yes, I just wanted to just say for example, so I think we should looking at Nigeria as a use case. Virtually every business pass costs. So the real question should be to what extent are we passing the cost, except in a
Mm-hmm.
economy, a socialist economy where there's price control. But if there's no price control, definitely they will definitely pass the cost. So the question we should be asking now is what is the extent of the cost that they'll be passing? I think that's my own twist to the whole thing.
Exactly, exactly. I love that. To what extent? And that is what we've also built into this model. So we are saying yes, cost is increasing, but please let's look at the pricing. Are we passing it the same 100%? If it is 100%, we are saying you should just select true, and we see how that will affect the profitability. And if it is no, yes, we are not still saying they will not pass it, but they might not be able to pass it at that same rate, right? So, as I said, you are a modeler, you're a financial advisor. You build it into the model, you should be able to defend it and to be able to say that. So this one, let's just link our cost index. So this one, instead of linking the rate, I'm just going to link the index. So let me delete this. Let me copy my format. So I don't need to put the format again. I just come here and just paste that and use that equal to my lookup, right? Look for the year. So I can, when you are building the formula, always think about reusing it. So F4, keep it constant, right? Comma. Okay, no. So lookup, I'm supposed to log the row, comma. Then, in case you don't know about cell referencing, please, it's a basic Excel that everyone must know. So click this. You can check my YouTube channel too. I have this on it. So then come to my costs, keep that constant and enter so that I have this. So for my pricing index, right? So copy this down and now come to all I need to just change is my row, my output, right? So this will become row 22 instead of row 18. So I'll just change this 18 to 22, 22. Then I can copy this for other period. Right, right. So today looks like a very interesting day because we really need to fully understand this. Yes, if it's the only thing that we are achieving today, I'm cool with that. But before we do that, let's look at the tax. So it's also part of it. So let's call this. But let's be consistent with what we are doing. So inflation. So let's cost incremental factor. Let's maintain our header. So incremental factor. So it's easy for someone to see and understand, right? Consistency. So this is our price. So this is price incremental factor. Then we now need our this is our tax rate. Now for this tax, it has two you have two options. But I always prefer option 2. So for option 1 is saying yes, most times businesses pay, a typical corporate approach is that they pay tax at the end of every calendar year. And that's why you can see that these corporate tax are more like annual tax rates. At the end of the period, you do all your account, then you calculate your tax on it. Now, another approach is, this is the corporate tax rate. But what we are going to do is you divide these tax rates. So let's just do it. So let me say this tax rate so that you can see. So tax rate, right? So I'll copy this my lookup function. I'll copy it. I'll paste it here. So this one I'll format it to percent, and I'll come here. Our tax rate is on row 27, right? So I'll just change the 22 to 27 because I'm using my cell referencing. So this is 21, right? Copy for the period. So for option one is saying, so this tax rate should be divided by 12. So I think we have 12 somewhere. So I'll call equal to, let me link that to our 12 month in the period. I'll just link it to this. To put it in my link cell style so that you know that it is linked. So I'll top equal to this 21 divided by what? This 12 month, which I'm going to keep the 12 month constant. Right? And I'll copy this for here. So I'll just copy it. So which means if I sum up this 1.8 for the first 12 months, it's expected to give me that 21%. Right? Now, the problem that will come in here is this. Let's assume there are some period where the business, they made profit, they made loss. Let's assume we are actually building a complete 12-month thing where the growth kind of varies. It's not as if everything keeps growing. So a period they make loss, a period they make gain, a period they make loss, a period they make gain. By the time you do the summation and you multiply by your profit before tax, it might not give you the actual rate. Yes, if you still use it like this, it is fine. In fact, some people even decide to use this 21% on monthly basis. I don't know. Maybe they're just trying to be tax. They are trying to be tax conservative. But my own approach is, we are going to assume that every tax would be paid at the end of what? At the end of the 12-month period. And as such, what we just do is we calculate all the profits from January to December. We sum everything up, and then we pay the tax we now apply that 21% at that particular period and not split that into 2. So to do that, I think I'll just create, so for the option 2, I'll create I'll call this end of period flag. Right? So let me copy this guy. Let me link it. So equal to, I just need 12 months, which is the end of every period, right? And I'll come here and I'll say equal to, open my bracket, right? My period counter that I have here. In fact, let's even use this. In fact, let's do it like this. Equal to month of my date. I'll close the brackets. So month, what we do is going to extract the month for you in terms of numbers. So if I up those to 12, so you can see, just extract the month in numbers. So this month, are you equal to, right? Because I'm saying, oh, the end of period is 12. So maybe if your own end of period is not 12, maybe the business is operating from May to June. So it's something like that. So just that means you need to be able to state the end of the period for that model. So are you equal to this? I'll close it. So let me put this in the bracket and multiply it by 1. So once it is December, multiply by 1. So multiply by 1, right? What's it giving me? Okay, so this, then I can remove this bracket. So multiply by 1, so close this. So you can see at the end of, whenever it is 12 months, which is December, it gives us 1. Other month will be 0. That month will be 0. So which means our tax rate will now be what? this mask, this end of period flag multiplied by what? My tax rate yearly. And I can put that. So you can see at the end of each period, you only see that 21% coming in at December. And that, so we just sum up all the profit that we made for that period and multiply by the end of the period tax rate. Right? But we're going to see that by the time we do our tax calculation. I just said we should include this in what we cover today. Right? So I believe today has been an interesting session. All right, please. And I really want us to understand this macroeconomic part because it's very, very important. In fact, it's one of the reasons why we actually build model so that to be able to see how macroeconomic data will actually impact your expected business performance and for you to equip you to take in necessary strategies needed to ensure that the business survives. So you don't just keep shouting revenue will be increasing, and cost is slowing down. But in reality, cost usually increased more than revenue. So that's where management comes into play to make sure that yes, we are able to contain these expenses, these costs, right, and still maintain revenue, a good revenue rate. So I thank you everyone. This way we put a pen to our session today. And please, as I said, it's always good you attempt. Don't assume you understand it, you know it by just looking. Make sure you make time. Anything I'm teaching you today, please know that I've done it more than 50 times before I can say, I think I know this thing. Even if you wake me up from my dream and bring it, I will tell you that, oh, this, I'm good to go. I will tell you it's this, that, and all those things. So please, someone is saying, should we not consider review of minimum wage as a macro factor? As I said, you are the driver. Anyway, it can affect your number. Anyway, it can affect your forecast, your revenue, your cost. Put it in as much as you can defend it. Right. So yes, today class is long, and please let's take our time to go through this and be able to also create your own. That's why I'm not sharing my own workbook. Check it, apply your own. In fact, you can go ahead and start doing your own calculations, right? Those ones you feel you could still understand how it works, right? And if not, just wait to our next class. So thank you everyone, and this is where we'll drop our pen. And thank you for being present in the session today. Hope to see you in our next session as we continue. And also please, we will also appreciate us to share one or two learning points on our respective LinkedIn. You can always copy me, at me, and on our LinkedIn. Let's share knowledge. Let people know that we're actually doing a great things. And trust me, especially what we've done today, I'm not sure there's any course you can take that can really take you through this. I've been I was in the training space, training industries for more than 2 years plus, right? I've trained so many people, so I've taken so many training courses. I almost any course, name the course, as long as it's financial modeling, trust me, there's really no training that can actually take you through financial model like this. Yes, then tell me the cost, name it for me, and trust me. All right, that's why we are teaching you the practical approach, the practical way of doing it, so that when you are building it, you know that yes, don't just understand it as just A, B, C, D, and the whole thing. Then whenever there's one intersection, it becomes a problem. You understand it in a practical way. So let's share knowledge. Let's people know. You can pick one or two learning points from what we've done today. Let's share it with people. Let people know that we're actually doing great things. So we share the video recording. Yes, right. Just be expecting that. So thank you, everyone. Let's make sure we enjoy the rest of our day. And please stay safe and stay good. And bye for now. And please, in case you have any question, I will just stay back for like 2 minutes or 3.